All right, everybody, Stocks by the Numbers. Welcome back. Today is Friday. It's the 2nd, and we just finished closing out basically the first week going into the beginning of February. And of course, as we see, markets just continuing higher, hitting these new highs really for reasons, in my opinion, just unbeknownst to me. I had a feeling I mentioned a couple of days ago in my video that they were probably going to bring the yields down to justify a higher pump in stocks, but that the 10-year was the one that you had to watch. And I mentioned that, in my opinion, it looked like as soon as they would bring it down to sub 4%, it almost immediately rebounded to reclaim that level. And as you see here, even throughout here coming into the afternoon, been trading for about 4 hours now, you can see that the 10-year is still up almost 4% here on the day and holding above 4%, with the 20-year here at about 4.33%. But the name of the company that I wanted to look at today is Arcos Dorados, I believe it is, Holdings Incorporated, ticker symbol ARCO, listed here on the New York Stock Exchange. Shout out to X Shades, X Music, who brought this one to my attention here. And what this company is, this is essentially an international holding company, okay? So you're kind of getting a couple of different avenues of an investment here through this one stock. And what this company does here, we come down, we look at the description, as you see. Arcos engages in the operation of restaurants. The firm operates and franchises McDonald's restaurants in the food services industry through its subsidiaries. And you can see here throughout Brazil, Caribbean, Northern Latin America, Southern Latin America. They're in Puerto Rico, Trinidad, Tobago, right? U.S. Virgin Islands. So this is very interesting because you're essentially investing partly into the what seems to be the consistent growth in the McDonald's franchise, but also at the same time, you're also investing into an international market as well, right? Outside of the States, branching out into, again, Brazil, throughout Latin America, South America. So what we're seeing here, the company, the revenue was kind of bouncing around, but as you see, it obviously took the big hit there in 2020. Everything got locked down. However, from that point, the stock has been absolutely raging, and we can see we went down from like this $3 level. Now the stock's sitting here at $12.64 a share, down about a third of a point, a little over 2.5% here today. And we can see that the 52-week high is sitting here at $13.20. So we're still kind of close to this high. You can see a slight rejection there off of this top fib at 13.05. And I just want to check the top of these candles here. 13 even, 13 even. Okay, so technically, we right here actually did form a potential double top here on the technical side, and we could actually have a pullback. I don't know if it'll drop that low, but of course it is possible, right? So we do have the potential to go down before we go up, and this is, in my opinion, just one of the issues with trying to find a brand name stock that's trading at a discounted or fair or undervalued price, right? Because markets obviously continue to keep climbing. It looks like the word is out here. We had big volume come in, as you see, from 2020. So people know that this stock was, at the time anyway, undervalued and was going to rise and climb back up nicely. So again, in the short term, potential double top, we could have a pullback here, maybe like 7-8% here, down a point. However, in my opinion, technically it should, of course, bounce off of that fib and continue higher and actually hit new highs, in my opinion. I do have one or two potential red flags that I want to speak about, but let's get into it. Let's get into the numbers here. So as you see, we have a market cap about 2.2 billion, right? The company's paying out a dividends, yielding right now at just a touch below 1.5%. We have a PE of about 15, right? So on paper right now, we could technically view the stock as undervalued, especially since the company's bringing in north of, 1-2 billion a year. We have a beta here of 1.15. Again, the beta is the volatility of the stock in relation to the overall volatility of the market. Ideally, in my opinion, you would look for something here in the very low ones or potentially sub 1 if you are a more emotional investor or trader, right? You would probably look for something that's less volatile than the overall market. But 1.15 beta, not too shabby. As you see here, we're looking at the EPS for the last couple of quarters. Company beat 3 of the last 4 quarters. Coming in last quarter, as you see here, almost 30% above analyst expectations. And usually when they beat, they knock it out of the park. And we can see this miss here. Yes, 7% miss. However, technically, they missed by 1 cent, right? So, I mean, we've seen worse. But overall, look at this growth here, quarter over quarter, 920 million, hits that billion-dollar mark, pulls back just slightly to 990 million, back up above 1 billion, As of last quarter, 1.13 billion. So this is a slow and steady climber, it looks like, in my opinion. Obviously, the profitability did take a hit, as we see here going into the tail end of 2022. Company net margin percentage roughly about 5.33%, and you can see it slightly begin to pull back here coming into 2023. And then last quarter, boom, they rocketed back up to 5.3%, which is essentially where it was before that drop began to take place. So in my opinion, looks like everything is potentially back on track. And you can see the dip and the recovery going into and coming out of 2020, right? So the company kind of chilling at this like $3 billion mark here on the yearly revenue for 2018, 2019. Again, bringing in $3 billion a year in revenue, $2.6 billion market cap currently. We can see the dip down here slightly below $2 billion for 2020. And then as everything reopens, we can see the climb back up here, 2021, $2.66 billion. And then obviously for 2022, we can see $3.62 billion. So technically, viewing that annual revenue in comparison with the current market capitalization of the stock, we could potentially say that the company is undervalued. However, I also want to point out a couple of metrics here that we're going to get to in a minute, but I wanted to bring up the forecast here looking at the stock. As you see, we have 6 analysts currently looking at this company, and all 6 are giving it a strong buy. Again, reason being is because the company, for the most part, is showing pretty consistent growth here over the quarters, over the years. And of course, we're talking about McDonald's franchises, right? So basically, as long as McDonald's stock continues to remain stable and it continues to remain a brand name fast food location here in the States and internationally as well, you know, these companies aren't going to have anything to worry about. But as you see here, looking at the forecast, we could potentially say that we may kind of stagnate here for the next couple of quarters. However, if we switch over annually, you can see that for 2022, they brought in $3.62 billion. For 2023, estimates up to $4.18 billion. And you can see that we consistently increase year over year moving forward, meaning that if this company actually delivers these numbers over the next couple of years, in my eyes, we can probably look for a potential 100% move from this point. Believe it or not. Again, that's just my opinion, but you know, doubling this up, we could potentially see about a $25 stock. Of course, it's going to be down the road. It's going to take quite some time. This is not going to happen in the next 30 or 60 days. So if you're looking for a quick mover, in my opinion, ARCO is not really that play right now, but over time, I do believe that it's going to grow nicely. And of course, again, they pay that 1.5% dividend yield. So you do the DRIP that we speak about, DRIP, that stands for Dividend Reinvestment Program. They pay you dividends. You do not take the cash. You reinvest it back into the stock. And now, let's get into the actual fundamentals of the company here. So if we switch over here, one of the few red flags that I'm seeing here, first of all, we can see also the company was increasing its dividend year over year, right? 2018 paying out 10 cents a share, 2019 goes up to 11 cents. And then, of course, everything gets locked down. However, the company still tried to maintain about half of that dividend payout here at about 5 cents a share. I got to give credit where credit's due. And then, of course, 21 to basically make that U-turn and get the company back on track. It looks like they had to cut that dividend completely, keep that cash on hand. However, going into 2022, not only did they reinstate that dividend, however, they upped it basically what looks like even more of a percentage as to where it would be if they never stopped paying it, right? Because if we're looking at a 1 cent dividend, 1 cent dividend increase year over year, then going from 10 to 11, here in 2020, we'd be at 12, here is 13, here is 14. But as you see, the company, again, basically brought in all its cash to keep it on hand, to keep itself afloat, then reestablished the dividend and actually bumped it even 1 cent higher than where it would have been if it was never decreased or cut in the first place. So I do have to give credit where credit's due. And of course, we essentially know that a lot of McDonald's locations are really just cash machines. They're cash cows, right? So for the company to reinstate that dividend and, of course, increase it just slightly further than where it technically would have been, in my eyes, I think that is actually a very, very good sign. If we look here, going from 2018 to 2019, you can see the debt jumps up from about 600 million and change to north of 1.5 billion, and actually basically maintains that level throughout all of these years here from 2019 to 2022. If we switch over quarterly to 153 billion, 156 billion, I'm looking at the debt right now, this pink bar, 159, 164, slightly down last quarter to 162. So in my opinion, this right here is one of the main red flags to keep an eye on here when it comes to ARCO. Because again, overall, I have a feeling that the company's probably going to be fine. However, the debt right now, again, this value at the current market cap, we're talking a little bit more than 50% of this current market cap value is debt right now. However, again, based on the revenue that the company is bringing in, of course, I wouldn't say they essentially cancel themselves out. However, again, if we do a little bit of arithmetic, we can see that there is overflow here from positive revenue coming in compared to the debt that the company's holding here quarter over quarter. In the short term, the company has liabilities outweighing assets, which is why I'm saying we could potentially deal with some short-term volatility maybe over the next couple of months. But overall, the longer term, I personally do like this stock. And again, because of what it's connected to and because of the international markets that they're kind of attached to, in my opinion, I actually think this is going to be a slow, steady, stable grower here, right? If we look at the income statement, we could see revenue basically not only kind of maintaining itself even when it dips down, but basically consistently increasing quarter over quarter for the most part. Cost of goods consistently increasing with how much business and revenue the company does. However, total revenue minus cost of goods sold yields gross profit. And we can see that quarter over quarter, almost consistently, minus a slight dip here, the company has been basically steadily increasing its gross profit. And this is why I like looking at these income statements and the balance sheets here on TradingView, because I was speaking to someone in the Discord. Again, Discord link in the description of every video. Free to join. You guys can come in. We can talk about stocks. We can talk about sports, whatever you want to talk about. But basically, the way it's laid out in TradingView is the way the economic formula is. Okay, so total revenue minus cost of goods sold yields gross profit. That's why it's listed this way. So gross profit minus the operating expenses brings us to the next line, which yields us operating income, right? So again, you don't necessarily have to know all of these equations by heart, memorize all of these. But, I just wanted to show you guys, how it works out and the way that they lay it out here on TradingView. But gross profit minus operating expenses yields operating income. And you can see, again, we had the slight dip here coming into 2023. However, it climbed back up and got back above here, 93 million. And you can see that before that, the high was about 81.5 million. So overall, for the most part, we can see just steady, consistent greens and increases on all of these metrics here that of course, are extremely pertinent for the company's, future growth here. But I am seeing basically nothing but green here. But again, this is the one thing that scares me a little bit, because as assets are growing, and again, consistently, nicely, going from sub 2.5 billion here, 2.4 billion, now as of last quarter up to 2.85 billion, very nice. However, in the same period, you have about a 10% increase in liabilities as well, going from sub 2.2 billion, slowly climbing up to the 2.3s, now sitting here at 2.4 billion, right? And again, assets minus liabilities yields total equity. So as we see here, the total equity has almost doubled from where it was roughly 18 months ago, going back to middle of 2022 here. So this is what I'm saying. The company essentially, on paper, is doing a lot of things right and is growing consistently and steadily. So all you really have to do is pick your spots here, in my opinion, with a stock like ARCO. And I'm pretty sure, I have pretty high conviction that over the years, you will probably find yourself in a significantly better situation. But again, you can see the debt here. It was slightly dipping down here, approaching that 1.5 billion, and then it ticked back up a little bit, getting back above 1.6 billion. So really, in my eyes, It's the short-term liabilities and this debt that the company is currently holding that really technically, in my opinion, are really the only red flags that I'm seeing here. We have a book value, again, significantly lower than where the stock is currently trading, right? Looks like the company's trading about 6 times this book value now. However, again, looking quarter over quarter at the growth here, the company was at the low $1 here, got right down to 101 a share, and then look at this steady growth, 115, 154, 168, 192, now above $2 a share. So that's what I mean. As long as the company consistently just really keeps doing what it's doing, in my opinion, I really don't think we're going to have much to worry about here with a stock like ARCO. Switching over here, let's look at some of these stats here real quick. And then we'll switch over to stock charts. We'll see if we're seeing anything over there. You can see the PE, for the most part, looks like it was down to this 10.6 level and basically up to as high as almost 13%. Now, we can see before that, I'm sorry, not a percent. Yeah, PE ratio, you know what I'm saying. But down here from 10.6 between about 13. And you can see at one point here, coming from early 2022, the PE was north of 17, right? So, of course, it's been climbing, and it's technically above the average that it's been for the previous 6 quarters here. It's sitting above 15 currently. However, this is not the highest that it's been. So this is why I always say that sometimes these stocks need some time. And even though we may see the numbers on paper increasing, the stock may actually sit stagnant or begin to slowly decrease and kind of drop into this like longer term consolidation channel. And technically it may not make much sense in the moment. However, we go back again, comparing it to something like Super Microcomputer that we just spoke about, SMCI. I mentioned that long-term consolidating channel that lasted, I believe it was like a year and a half, 2 years or something like that, with the stock down at the low mid-teens. But on paper, the company was growing. And if we got emotional in that situation, we would have said, you know what, the numbers don't matter, the fundamentals don't matter, I'm selling this stock, it's not doing anything for me. And now we turn around all of these years later and the stock is breaking through $300, $400, $500 a share, hitting these new all-time highs. So all you had to do was stick with the fundamentals. And again, in my opinion, that's one of my rules, follow the money, follow the revenue. And really, it really appears like 9 times out of 10, it usually works out for you, especially if you give it some time. Because that's what people forget too. Everyone wants to get to that level. Oh, I have a couple of $1,000. I need to get to 50,000, 100,000. Oh, I have 100,000. What's the fastest way I can get to 500,000 or 1,000,000? And the problem is, when you're looking for those insane percentage returns and that really rapid growth, that is when you are taking on a substantial amount of risk. And that's what I'm trying to bring to the table here when I make these channels. Because the institutions out there and the big boy investors, I promise you right now, they accumulate for size and they look for slow, steady, stable growth. When they buy a stock, they look for where it's going to be in 1, 2, 5, 10 years down the road. They don't look at a situation, find some juicy numbers, and then roll the dice on some out-of-the-money naked calls expiring for next Friday, looking to make 500 or 1,000% returns for themselves. That's not what they do, I promise you. This is why I consistently say that, in my opinion, one of the best strategies is to work smarter, not harder. Why take on that extra added stress, that extra added risk, when essentially, in my opinion, you really don't have to? You have great, smaller cap, consistently growing companies out there, like ARCO right now that we're seeing here in the numbers. And essentially, all you have to do is give it some time, and in my opinion, you'll be fine. But we'll switch over here and go back to our valuation ratios. And we can see price to sales now up to 0.65, right? So looking back again, we can see that this Q1 of 22 was one of their higher valuated quarters here. And we can see the price to sales was up to 0.59. After that, kind of just sat between about 0.45, got as high as 0.54. And now we can see currently sitting at 0.65 times sales. So technically, going back the last 7-8 quarters here, this is the highest it's been trading in comparison to its sales. But in my opinion, I actually think it's justified because the company's backing it up with their revenue. Price to cash flow right now trading a touch below 11, as you see. significantly higher than where it's been for the last 6-7 quarters. However, again, in my opinion, the company seems to be, for the most part, maintaining its business or consistently growing its business. So, to slowly inch them up over time isn't, we're not pulling that out of thin air. We're not technically trying to force the stock higher here because, again, in my opinion, they have some of the numbers to back it up. Price to book, again, we looked, now book value above $2 a share, right? So now they're trading 6.18 times book value. However, of course, we go back to one of their big quarters here, early 2022, and you can see that the company was trading over 7 times book value. So even if we get back up to that, going from 6 to 7 times book value at $2.10 a share, we're talking about $14.70 a share, right? So that's why I'm saying, in my opinion, given some time, the company will most likely continue higher and hit new 52-week highs here. Enterprise value, again, technically what another company would be willing to pay for this company. As you see here, current enterprise value, $4.1 billion. Current market cap of the stock, $2.67 billion. So we're talking about essentially about a 50% increase. Well, not a 50% increase. It would be technically a 50% premium from where the stock is currently trading, right? Which, of course, would bring us to about $18.50, potentially $19 a share. If the market cap lines up with the current enterprise value, we would be looking at about 18 and change a share right now. Stock currently trading $12.69. Return on assets here, checking out our profitability ratios. Return on assets, highest it's been over the last 8 quarters. Return on equity sitting here 52.68. Of course, not the highest it's been here, was a couple of percentage points higher. However, of course, even back here, one of their better quarters, return on equity was sub 50%. Now it's above 50%. So in my eyes, I view that as a slight positive. Return on invested capital up here almost at 10%, highest it's been going back the last several quarters. The gross margin percentage, again, technically not the highest it's been. They were about to hit 15% and then slightly pulled back into the 13s. But here, rebounding back up to 14.5%. So again, technically not the highest it's been. However, looking before and after that, between 12.5%, 13.5% for the most part, and now we're up to 14.5%. So margin percentages are big here. That's what a lot of analysts look for. And in my opinion, that is a huge positive here for the stock. Same thing on the operating margin as well. You can see we're up here to 8.29% and going back for the most part really between 6 and 8%. So they touched that 8% mark a couple of times, but to really pop up for that next leg higher, roughly a quarter of a point higher than the high it was several quarters ago, in my opinion, that's a big green flag. The EBITDA, earnings before interest, taxes, depreciation, amortization, up here to 11.6%. And we can see that we came from high single digits and we're kind of skating at those lower double-digit ranges, almost retesting and breaking below 10. But for the last 2 quarters, jumping up to 10.7, now up to 11.6. So this is what I'm saying. Technically, on paper, the company appears to be doing everything right, but it is those short-term liabilities and the debt that the company's holding that, in my opinion, may be just a few red flags that could potentially stagnate or even see a stock sell off here in the short term. Again, we pointed out the double top that formed on the technical side. So, I'm looking at this company again. Shout out to X Shades, X Music, who brought this one to our attention. But again, on paper, in my opinion, I think the company looks pretty good. However, I did mention some potential red flags. So if it does go down first before it goes up, hey, listen, I don't want to hear it. But looking at the net margin percentage, we looked at it before. It was up here, got up to above 5%, 5.35%, dips all the way down to about half that here at 2.73. Now basically doubles itself back up here to 5.31%. So basically a lot of these metrics you look at appear to be positive. Inventory turnover, it is bouncing around, sitting here 71.29. Not the highest it's been, not the lowest it's been. However, it does look like the company is consistently maintaining that 70 plus benchmark. So you really can't beat them up too much for that. And even though we were speaking about the short-term liabilities here, we can see that the asset turnover has been consistently increasing quarter over quarter, which is definitely nothing to sneeze at. Going from 124, look at this jump here, 136, 144, 45, 47, 153, now as of last quarter, 158. That is a pretty significant jump here. If we look back here from this level, I mean, you're talking about, around a 25% increase now. So, again, the company, in my opinion, seems to be doing a lot of things right. However, the debt, the short-term liabilities, this is what could potentially give us a little bit of a sell-off here in the short term before potentially taking that next leg higher and seeing more growth here in the short term. But you know what I always say? If we find a decent company and it looks good in the fundamentals and even in the technicals as well, all we have to do is remain patient, wait for a little bit of a better price. We buy those dips, we sell those rips. But again, you can see kind of holding that $1 billion mark going towards the second half here of 2024. Looks like they're expecting revenue to pick back up here, jumping up to $1.2 billion, which would essentially be the most, I believe. So that's why the company looks to be showing us that, 2023, still seeing some growth, excellent year, 2024, looking to be even better. And of course, consistent growth here going into 25 and 26, breaking above that $5 billion mark. So that's why even if the company comes in line, in my opinion, again, remember, enterprise value was $4.1 billion. Company estimated annual revenue for 23, $4.18 billion. Current market cap, $2.6 billion. So that's why I'm saying, even if it comes in line with that enterprise value and yearly revenue, you're talking about a $4 billion plus market cap, which is roughly 50% higher, again, from where the stock is currently trading. So it's going to be hard to potentially time your entries and pick your spots. But in my opinion, again, given more of a longer term trade, probably 12 months, but inside of the next year plus, I think that we're going to see some nice growth here with ARCO. And you can see you had the dip down in the Brazilian market here, dropping down to sub 1 billion. And now, of course, you're seeing a very nice rebound coming out since the lockdowns there in 2020. And for the most part, you're really seeing that across the board. Again, look, Southern Latin America sitting here between like 8 and 900 million, right? Begins to dip down. 2020 takes a huge hit, doubles back up in 21 from where it was, and then jumps about 50% higher year over year, up to north of $1.25 billion. So that's the most going back 2016. So this is what I'm saying. Even Northern Latin America, again, you can see the steady growth here going from the threes to the 400 millions, takes a hit back down to the 300 millions there in 2020. And then look at that growth coming out of those lockdowns here, 780 million up to over 900 million in 22. So this is why, again, essentially, you are really investing into McDonald's franchises, and you're doing so internationally, outside of the States here. So that's why, in my opinion, ARCO, I actually think is looking pretty decent on paper. But again, in the technicals, we did have that potential double top. So keep an eye on that. And looking here at stock charts, if we do start to sell off because of that double top, again, chances are we can see we recently bounced off of this mid-Bollinger Band, but 1236, even retesting here to the 50-day moving average 1221, not really too much of an issue. But the bottom Bollinger Band here on the daily, you can see 1164. And look, if we come back here, you can see this fib. Am I looking at a 1 year or a 5 year? This is a 5-year chart. Okay, so the 5-year fib here at 0.68, you can see 1162, and on the daily, our bottom Bollinger Band, 1164. So, again, in my opinion, 1266, I feel personally, pretty decent buy. If I like it at 1266, and they drop it $1 down for me to this level here of 1164, if I liked it at 12 and change, I'm going to love it at 11 and change. But even a pullback here at the 200-day, 1021, of course, anything could happen, and that would be a big percentage drop. However, if the fundamentals, again, look like they're consistently growing or remaining stable here at these levels, then if you drop me down to this valuation, I can just add to my position and average down. But we have an RSI here. You can see we were above 70 for quite some time. However, this was during this massive rally, of course, throughout November and December. And now it seems like the markets are continuing this rally for reasons, again, in my opinion, unbeknownst to me. But here we can see an RSI sitting slightly above 55 and a third. So kind of basically in the middle of that benchmark of 30 and 70, which is why I'm saying we could potentially drop down and sell off a little bit first before bouncing and climbing higher back into the 13s. And also, seeing this bounce off of this mid-Bollinger Band just a couple of days ago, you can see it looked like the MACD was about to cross and break to the downside, and then kind of bounced off that level and flattened out and rose up a little bit. So, you know, in my eyes, I'm seeing a lot of positives here. We can see, again, the company hasn't been below the 50-day moving average since about the beginning of November. And even though it tried to retest, we're seeing some very, very healthy bounces here as of late. And, of course, just from November alone, we can see this 50-day moving average going from about 9.5. Now it's up to almost 12.25. So, again, it's not necessarily a guarantee that the company will stay above these levels. However, consistent, slow, steady growths in these moving averages essentially could be viewed as potential support levels for the stock, right? So we could, of course, pull back to 1021. However, because that moving average has been slowly climbing and got up to that level, now it could potentially bounce off 1021 and head back up into the 11s, as opposed to back here when it was 8.5, 8.75, right? Then we could have dropped, 40% down to 8 and change before bouncing and potentially climbing. So that's why seeing these nice, steady increases in these moving averages, very, very good sign. Switch over here to the weekly quickly, and I'll let you go. You can see top Bollinger Band on the weekly, 1393. That's why I'm saying in the short term, we could potentially form that double top. We could pull back. We could sell off here down to, 11, 11.5. However, after that, a jump up to the high 13s or 14, hitting potentially new 52-week highs, in my opinion, very, very feasible. And now look at the difference here, right? Because we saw the stock on the daily staying above the 50-day basically since November rally, right? But if we switch over here and we look longer term for the weekly, I mean, look at this. Minus this little break here halfway through 2023, the stock has essentially stayed above this 50-day moving average on the weekly since the beginning of 2022. We are now in the beginning of 2024. So what you're telling me is, over the long term, with the steady, stable growth here of the stock, it has been 24 straight months, almost, that the stock has stayed above this 50-day moving average on the weekly. Extremely, extremely impressive, in my opinion, and also shows us stability. Look at that bounce right there, coming right down to the 50-day, and then boom, popping up to the top of the Bollinger Bands here. Even here, as markets sold off, you can see drop down, and then boom, that was the that summer rally that began there, May, June, July. Look at that, just shooting up. Where is this level? 7. Going from 7 to 11 and change. I mean, let me tell you something. That is not a percentage move to sneeze at. And then same thing here, when markets sold off, tail end of the summer, going into Halloween, right? Stock goes from 11 down to only 8.5, right? So we're consistently appearing to make higher highs and higher lows, which technically means that the stock is trending upward and basically maintaining that bullish momentum. And you can see as soon as it dipped down there, touches that 50-day moving average on the weekly, and then boom, just has that massive explosion that we see here in the last couple of months. Slight pullback again, boom, pops right back up to were those highs hit right there? Yeah, see, high 1320, that's 52-week high 1320. RSI here on the weekly has been above that 70 benchmark for a couple of times for a couple of weeks, but right here, as of late, got up to that 70 mark and then had that slight pullback. And here right now, RSI on the weekly sitting here at 66. So again, could be viewed as a little high on the RSI side. Again, we do have the potential double top on the technical side. So that's why I'm saying we could have a little short-term sell-off before we just continue our rally. But I just wanted to try to cover all bases for you guys and show you, obviously, the fundamental metrics. And, of course, more importantly, some potential technicals here that caught my eye. But the MACD here on the weekly does look pretty stable and seems to be climbing nicely. So overall, in my opinion, it looks like we have a nice, steady, long-term grower here. And again, not only are you diversifying a little bit into some international markets, but you're doing so with a brand name franchise on the back burner there with McDonald's. So, I mean, of all the companies out there, there definitely are worse ones than Arcos right now. But again, shout out to X Shades, X Music. He brought this one to our attention. I always give credit where credit's due. We could potentially, of course, be forming some sort of, long-term rising wedge here, which again is why I'm saying a lot of the technicals could potentially be showing us a little bit of a short-term sell-off. But overall, we keep making these higher highs and these higher lows, and the numbers do seem to support it. So I have to say, I'll go on record here, even if the stock goes down first, I'll go on record and I'll say, personally, in my opinion, I like ARCO here at this level, and for the longer term, I'd be a buyer. And I'm going to leave it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel, okay? And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But of course, more importantly, moving forward, like I always say, I understand that markets are rocky and volatile and very uncertain. I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. You all have a good day.